Hello everyone, this is Arif and today we are here with another CIA Part 1 video. Today we will be going through Unit 3, which is a continuation of the previous unit, Assurance Services. This is a brief snapshot of my career, my professional background. Just in case if you are interested, you can pause the video and you can read it, or you can connect me via LinkedIn as well. This is an overall snapshot of the CIA overall syllabus. Here we can see that so far we have covered the foundation of internal audit in Unit 1. And in Unit 2 and in 3, we will be covering about assurance services. Similarly, then we will go to advisory services, ethics and professionalism, risk management, controls, and fraud risk. And that's how we will be concluding our entire exam topics within the CIA Part 1 syllabus. This is a brief overview of the entire syllabus in terms of syllabus coverage, expected MCQs that might appear in the exam, and what are the key topics that we have already covered and what we are going to cover in the upcoming units. So far we have covered up to 20% of the syllabus in Unit 1 and Unit 2, and approximately you can expect around 24 MCQs out of these two units. Overall, we have 125 MCQs, out of which you need to score approximately 80% correct in order to pass the exam. In Unit 3, once we complete this, hopefully we will be making a coverage about 30% of the entire CIA Part 1 syllabus. And overall, we might be covering around 35-36% of MCQs that might pop up in the exam from these sections. Just to have a look at what we have covered in Unit 1. In Unit 1, in the foundation of internal audit, we have covered what is the purpose of internal audit, where we go through the definition of internal audit. We discuss about the internal audit charter, which is the basic or the most important document that define the role and responsibilities and authority of the internal audit. Then we discuss one of the most important concept in internal audit, that the internal auditor has to be an independent, and what are the key elements that impair our independence and how to overcome those situations. We also discuss about the role of internal audit risk management. It is an important topic because in today's time, there are emerging SMEs which cannot afford to have two distinct internal audit and risk management departments. Sometimes they combine the role of internal audit with risk management. So there is a risk of impairment of independence. So how to deal with such situation that we have covered. So overall, some of the basics and the core of the foundation of internal audit we have covered in Unit 1. Whereas in Unit 2, in the assurance services, we have mainly covered 4 types of internal audit engagements, where we have discussed about in case if you have to audit a third party or a contract with a third party, how we can cover the audit from the audit aspects, how we can carry out audit on third party. We have also talked about the quality audits, if in case we have to perform. The third type of engagement which we discussed about was security and privacy audits, and the last one was performance audit. With these types of engagements, and to give you an overview how we as an auditor approach these different areas of the businesses, try to IIA is trying to equip you to understand the practicality of the internal audit, how to identify key risk, how to deal with such situations, and how to perform or apply audit procedures. However, these are not the only areas that we are supposed to cover. So there are certain more areas in assurance services which are very much important, which we will be covering in assurance services Unit 3. And in the next slide, I will take you through what are the other types of audit engagement that we will discuss in today's video. There are some other types of audit engagements that we will cover in Unit 3. The operations of companies, how we perform operational auditing, then compliance auditing, financial auditing, which is one of the very fundamental and basic type of audit. We will also be performing organizational cultural audit, which is a bit kind of I would still say, a new area for audit engagements, and also how we as an internal auditor carry out review of management reports, either being independent, like to perform as part of the review for a specific area of a management reports, or use management reports as an integrated or kind of additional steps that we perform in any of other audit engagements. So these are some of the core area of audit engagements that we will be covering in our assurance services unit 3. The first type of audit engagement that we will look into in this unit is operational audit engagements. Operational internal audit engagement is not a specific audit of a specific area. It could apply to different organization in a different context. So you need to understand the concept rather than thinking like it's in a specific area that we have to perform an audit. Operations, as it goes with its name, could be any type of industry or sector where you are working, and within that sector or industry, if you review or carry out the audit engagement of any specific process, that is falls under the operational audit engagement. There are mainly two types of engagement under operational audit engagement. The first one is process or functional engagements or program engagement. The difference between a process and a program engagement is very fundamental to understand. A process is an ongoing activity which never ends. So this is part of the ongoing existence and ongoing activity within the organization. Just take as a human example. For example, eating food is our ongoing need to survive. Similarly, within the organization, there are certain processes, production processes, financial within the finance, procure to pay process, hiring and firing of the people, inventories coming, going out, buying capital or carrying out capital expenditures, forecasting and budgeting. These are all processes which is ongoing on a routine basis. And if you are looking at those processes, then it falls under the process audit engagement, under operational audit engagement. A program is basically kind of one-off activity which has a start and end, and once it is being performed, generally it is not repeated. For example, there is a specific project review, and once you carry out that engagement, then there is no need to, because the project is being closed. For example, post-implementation review of different systems. It could be to assess the cost-benefit analysis of any specific capital expenditure within the company. It could be a kind of a one-off feasibility study review. These kind of engagements where it's one-off and it's for a specific period of time, and where we are trying to assess whether is it cost benefit, assess the effectiveness of cost benefit analysis, whether we see the desired output of those programs has been achieved or not, the effects of those specific programs for a bigger objective has been achieved or not. So those are the key objectives due to which we carry out program audit engagement. So mainly you have to understand operational audit is a generic engagement which might cover in any kind of organization, be it in banking, manufacturing, services, NGOs. And within the operational accounting audit engagement, you have mainly two types of engagement, either process or one-off, which is called program audit engagement. Another type of audit engagement that we are requested to be performed is compliance audit engagement. Compliance, as it goes with the name, it is to comply whether we are in abidance of something. What is that something? It could be a law, it could be a regulation, it could be a company's internal policies and procedures, it could be a contract, certain plans. So these are all types of compliance audit engagements. It might be that within an audit engagement, you review a small section with the compliance of that area with the regulation or not, or you could have a complete scope of area for compliance audit engagement. It could be that you also perform a compliance audit engagement on a compliance department, whether to ensure that whether they safeguard the company in terms of any violation, non-compliances, are they reporting or not to the top management, and are the management or not, are they taking the right course of action or not. Generally, as an internal auditor, whenever we have a compliance issue, we have to see if there is a legal matter involved. So we have to go back to the legal counsel or the legal department within the company to seek their opinion, rather than concluding everything by our own, because we have to be very careful, because there are laws and regulations, and there could be fines, penalties, and other consequences in this type of audit engagement. Similarly, if we do not have the competence of carrying out certain compliance review, then we need to seek an expert opinion in that specific area. There are many times we are working in a very specialized industries. For example, in healthcare, it could be a very high-tech based environment where we might not have the expertise. Sometimes it could be any other types, pharmaceutical, where they carry out R&D, and we have to ensure that the compliance with the health regulation, are they carrying out those activities under the compliance of the health regulation or not. In such areas where we do not have the competence, then we have to engage an expert to assist us in carrying out compliance audit engagement, or we can fully outsource as well. Why we need a compliance audit engagement? What is the benefit to the organization? Basically, the organization, we help the organization to identify any non-compliances, whether starting from internal policies and procedures to regulations and laws or contractual terms. It also helps us to detect any employee violation, illegal acts, or any violation of disclosures if we have to make in which we haven't done it. So overall, these are some of the benefits that the organization get out of these kind of audit engagements. And we also give assurance to the management and to the board or audit committee members that whether the organization is abiding by the laws or expected compliance legal framework or not. Generally, whenever we talk about internal audit role, in terms of the area coverage, we classify those areas into financial, operational, compliance, and IT related controls. So this is a 4 broad classification of audit engagement, which we have discussed in detail in the previous unit. Here we are going through again, but in terms of more detail towards one of the aspect of the 4 key element of the internal audit engagement. That is financial engagement. In financial engagement, we more or less act like an external auditor, because the techniques, the tool, even the objective of the internal audit carrying out that engagement remains the same. What we look in the financial audit, we look at all the aspect related to financial reporting process, which comprises of collecting the information, preparing the financial information statements, and disclosure related to notes. So these are the key 3 vital things that we look into it, and there are what we look into these areas is basically the control environment, whether the controls are working effectively, and to ensure that the management which are giving an assurance that whatever the numbers they are recurring, or whatever the numbers they are presenting to the shareholders are true and true and fair. So this is what we also test as part of our internal audit. Generally, the management is responsible to ensure that there is nothing wrong with the numbers. They are not misrepresenting to the shareholders, and that is being audited by the external auditor. Internal auditor, they also do the same thing, but there might be a small aspect of the engagement that we do. Just to give you an example, for example, when we might have planned in our audit engagement, let's say revenue recognition. In the revenue recognition, we will look at what were the key revenue streams, who are the suppliers, who are the buyers, how much receivables we have, what is the aging process. So we will be digging down in terms of recognition of revenue, the timing of recognition of the revenue, will there be any bad debt. So these all aspects we will be looking at, but in specific, there is one area that we cannot miss out, is the financial reporting process. So whenever the management is putting forward any numbers associated with revenue, be it in terms of receivables, be it in terms of any bad debts or any other provisions, that needs to be accurate. And to ensure that, we follow the same step as the external auditor does. But just because external auditor does not have too much of time, or sometime their focus is only on reporting side, we look into overall holistically, but then we dig down and we focus on the nitty-gritty detail as well. The management either implicitly or explicitly give an assurance that the measurement, presentation, and disclosure of the financial statement is true and fair. So this is their job, or this is their duty. They in order to give that assurance, they provide certain assertions. We call it audit assertions. What are these assertions? These are basically certain attributes related to a transactions that they ensure that this transaction has been occurred, which they have recorded. They have completely recorded, so there is nothing missing out in terms of the transaction, maybe in terms of the entire amount. The numbers are accurate. That the cutoff is basically a concept in which we say that generally there's a financial reporting period. So let's say if it is start from January 1st and end 31st December, so we will try to take a cutoff on 31st December of that transaction. We will not continue anything that correspond to or falls in the subsequent year. So that is a cutoff. This generally applies in terms of financial transaction when we are making, and we also in inventory take as well. Then existence of that transaction or that assets, which if for example we are looking for physical assets, so existence of that. So there are certain kind of these assertions which the management either implicitly or explicitly assure that they are all there in order to ensure that the statements are prepared true and fair. What we as an internal auditor do, we test those assertions. So we will take those transactions, we look at all the attributes. Does all these attributes fall there, or being or accurately reflected and recorded? And if it is okay, then it gives us the assurance that the design of the control and the application of that control both are in a healthy manner. If there is any deficiency, either in terms of not recording the complete transaction, so we have to look whether there is a design problem with the internal control, or if they bypass that control, or they did not use that control effectively throughout the period of our audit. So this is a brief nutshell, and there are more aspects to the financial engagement which we will be discussing the next slide. In terms of risk and towards financial statement, we could have risk of revenue overstatement. This is a very common where management foresees certain kind of a sale, or they made a sale, but the risk and reward of that, it's a technical thing that in accounting, the risk and reward needs to be transferred to the seller before you record the transaction. So if that is the case, that the risk and reward has not been transferred, but we recorded the sale, or maybe we recorded a sale as a future commitment towards making that sale. So there are certain accounting IFRS rules that we have to take into account and ensure whether the management does not overstate the revenue. Why the management would like to overstate? Obviously, to bring the numbers more favorable to the shareholders. Expense understatement, this also happened. One of the very common example would be that to capitalize the expense. So you make a daily routine small here and there expense, but you capitalize as an asset. So when you capitalize an expense as an asset, then the expenses reduce. So this is an understatement of expenses, again to give a positive picture of financial statements. Applying unreasonable accounting estimates, this happens sometime that we are using. So in IFRS or in the accounting standard, we have the provision to use certain estimates, and certain the standard give us some kind of flexibility to evaluate our situation, and then use as per the industry practice, or as per the whichever is more favorable. So sometimes they can use that area and use the estimate which will result in more favorable result to them or to the reader, rather than the one which is supposed to be used. So this is also one of the areas that could lead to a high risk. Applying outdated accounting principles. So there is a change in the accounting principle, but they are still using the old, in which they are non in compliance with the IFRS or International Accounting Standard, leading to overall misrepresentation of the financial statement. So these are the key risks why internal auditor or external auditor both are very much concerned about the financial audit. Whenever we are doing a financial audit, we as an auditor, we classify into different accounting cycles, different processes, because it's much more easier for us to track a process from initiation to end. So one cycle could be sales receivable to cash receipts. So basically, when you made a sale, you will start the process from there, then till the time you book the receivables, and later on when you receive the cash from the customer. So you will look at the entire cycle and all the key activities that are involved, and how the accounting and recording has happened, and as per the IFRS or not. So this is one cycle that could be audited by the internal auditor. There could be other, just such as purchases, payables, and disbursements. Again, from raising a purchase order, or having a purchase agreement, or having a receipt requisition to procure something, to making a purchase order, then recording the accounts payable or liability, and then finally making a payment. So this is another cycle. Then production to conversion cycle. So starting from having that raw material turning into a product, and then taking it through the production cycle, and then turning it into a final product. So that could be one. Financial capital and payment cycle. So this section basically comprises of our investment and treasury related matters, investment, stocks, debt, interest payment, dividends, how the company is dealing with these areas. Personnel to payroll. So how the payroll or the wages or salaries are being made. External financial reporting cycle. External financial is the overall recording of the entire transaction throughout the year, and then how they put forward that into a trial balance and ledgers, and eventually in the form of balance sheet, income statement, changes, and equity. So these all statements, how they make it. This could be in itself audit engagement area. So internal auditor might not be doing a holistically overall review of the entire financial statement, because generally that is being carried out by the external auditor. But sometimes what we do, that we go into detail and pick one area or two area, and then we carry out very extensive audit in terms of looking at all the aspects of internal control and control design. But however, if an internal auditor wants to do, they can do, but generally we leverage from the work of external auditor. So this is something about in terms of the accounting cycle. One of the key reasons why we are so much fond of the financial engagements is because of high probability of fraud. And that is one of the key elements that even the IIA or IPPF standards also mandate us to look the operations or the financials matter from the fraud risk angle as well. So just to ensure that we carry out our audit procedure to ensure that the financial statements are free from any material misstatement, whether caused by fraud or error. One thing I would just like to add here, that if you have gone through the ACFE, Association of Certified Fraud Examiner report, they have an annual report in which they tell us about the type of the corporate fraud that is happening. One of the key areas which they highlighted, and mostly on the top of the type of the fraud, is misappropriation of assets or misrepresentation of the financial statements. The people who are at the junior bottom of the company or mid-level, they generally go for misappropriation of assets because they have more access to the assets, but their value is relatively less. But those who are very experienced and are at the top of the company, they, whenever they conduct or whenever they try to cheat the company, or under any pressure they have to commit something wrong, they do the misrepresentation or manipulation in the financial numbers. Maybe because they have extra pressure from the board that to achieve certain unrealistic target, maybe because they want to show a very positive image and reap their bonuses in the short term. So it could be for any reason, but that's one of the areas why we are so much inclined toward looking at in terms of control environment. Assessment of internal control. In many companies, they have their dedicated subsection or a department. They call it. I remember in Telenor we were having within the finance department, we call it. It used to call financial control department. So basically what they do, they look for all the types of internal control over financial reporting, and this is a reason why a lot of SOX compliance companies which are listed in the stock exchange, in the US stock exchange, that they have to comply with the SOX compliance. They also look for to have this department in order to ensure that no issue arises as part of a SOX compliance, because SOX compliance is more inclined toward financial controls. Therefore, many companies, they have this financial control department. It doesn't mean that all the companies which they are listed on stock exchange, New York or US stock exchange. No, some company does they just wanted to have it, and some companies because of SOX compliance as well. We as an internal auditor, we are not supposed to just presume that everything is happening the right way. We have to test, we have to ensure that we collect the right evidences, we carry out proper testing, and apply proper audit procedure in order to ensure that the controls are working effectively. We also have to ensure that the cost benefit analysis, because sometimes the benefit which we achieve of deploying an expensive control does not justify. So we have to look at the cost effectiveness, because we also want to add towards the company efficiency and effectiveness. There are many internal control frameworks that the company can deploy. COSO is one of the framework which is more commonly used. The purpose of these frameworks is just to give a structural approach to ensure that there are proper control environment within the company, and control are always a continuous process. So we cannot take it as one time job that once you have implemented a control, then you dust it and you said my job is done. No, it's not the case. In terms of internal control, you have to keep on evaluating whether these controls are relevant, because these days companies are very dynamic, they change, and also the regulation changes, the accounting principle changes, the standards change. So you have to keep on changing and modifying, and that's one of the reasons why internal auditor keep on testing in order to ensure that the controls still have the relevance within the company. Whether it be it in terms of financial audit or any other audit, the general premise of an internal audit remains the same. We carried out our risk assessment from the perspective of fraud as well. And again, we allocate our resources and internal auditors to perform that engagement. And especially in terms of financial audit, we provide the assurance services in terms of financial reporting, corporate controls, and governance matters. In terms of financial reporting, the key areas where we look at the compliance with the applicable company's policies and procedure, code of conduct, regulatory filing. If there is for example, if a company is big enough that they are a listed company, so they have a regulatory filing which needs to be carried out properly with the correct numbers. And that's where we have to also carry out our test that these numbers are correct to the regulators, which the company provides to the regulators. We have to look the financial matters from the risk of fraud as well. Just remember one thing, that even the same discussion we have done in last unit, I think unit 6 or unit 7 of CIA part 1, that it is not our duty to carry out a fraud investigation unless until we have the capability to carry out, and we are mandated by the audit committee that we can carry out, and it is provided that provision in the internal audit charter. However, to look at things from the risk perspective, from the fraud risk perspective, that is our duty. But just let's say we felt that there is an element of a fraud, and if we believe that we have the capability, and if there is no dedicated resources within the company, sometimes the company have a fraud to fight against fraud, anti-fraud department. If the company doesn't have, or they doesn't want to outsource, and they give us the responsibility, then we can carry out a detailed level of review. But if we lack in our competence or in any kind of resources, maybe internal audit resources or time constraint, then we should explicitly make that statement to the audit committee, and we should not accept such kind of engagement. So that is one thing which needs to be clear, be it in the from the perspective of financial fraud or operational fraud or anything related to that, so that we have to be very clear in terms of our role and responsibility as an internal auditor. Whenever we are planning for a financial engagement audit, there are certain things that we have to keep in mind. Our plan should be flexible. All the key major area of the scope area of that financial engagement needs to be covered. we should be able to be, or we should be mentally prepared that if there is any unexpected change, be it in terms of scope area, be in terms of competence that you, or additional resources that you need. There are times when the finance team is so much busy that you cannot get a dedicated resource for certain area of review. So any type of unexpected change that you should be familiar with and you should be able to account for in your planning. Consider the relevance of other people's work, because in the financial engagement area, external auditors has performed their work. Sometimes there are regulators who have carried out their audit engagement. Sometimes the second line of defense, we have financial controls team, we have other compliance or maybe other risk management team which has carried out certain reviews, certain type of review or testing, so that we can either use it or whether we can share our information with them or not, that needs to be taken into account, and we can consider the relevance and the need and the authority to do that. But whenever, just bear in mind, whenever we are using anyone else's work, the responsibility or is on us, that we have to take the responsibility for the review and giving the opinion. We cannot put our lack of audit procedures as their responsibility. So we cannot do that. We have to perform our audit engagement, but just because we want to save time and we want to make it things quickly. So in that case, if we are relying on other people's work, the responsibility still rests with us. CAE shall inform the board and senior management gaps in audit coverage. So if there are gaps, you have to mention. It happened to me that I was carrying out an expense review, but in that I felt that VAT, value-added tax area, was quite extensive, and I wasn't, I didn't had resources and had a time constraint. So I removed that area from my audit scope, which I ultimately informed to the audit committee. So if that is the case, you have to inform to the audit committee so they know which area you are giving the assurance about and which area you haven't touched base upon. Another type of audit engagement that we perform, it could be part of an audit engagement or a standalone activity, that we review management reports. There are different types of management reports within the organization. These are not mandated by any regulations or by law. These are reports which are meant to be for decision making by the top management or by the line management, and it is also kind of give the overall status of what's going on in different operational activities within the organization. These reports basically as a whole give a performance review, KPIs achievement, or in order whether we are in alignment with achieving the overall objectives of those business operational activities or not. Generally, you can classify these kind of reports into financial data or financial reports or operational reports. As you might pretty much aware that the financial reports will be more or inclined toward the financial numbers and the cost benefit analysis. This kind of reports it will be, and in the operational it is more about efficiency, effectiveness, achievement of objectives, or whether we have achieved our desired outcomes of those activities or not. Some of the characteristic of these operational reports are they are supposed to be very clear. It has to be timely prepared and shared with the right people for them to take the right decisions. It has to be relevant, so there should be not distraction. It has and double meaning, so it has to be clear and concise and actionable. It has to be action oriented, which means that the people who review these reports, they should be able to make or to guide or to take an action on these reports. It should also highlight the risk and opportunities that we should be aware of. So these are some of the characteristics of these reports. Some of the examples we will go through, by which we will understand what are the main types of these reports. The first one is financial, which could be related to our cash flows, variance analysis, budgets, and these kind of thing. We can have operational, and operational reports could be similar to what we have earlier discussed in the operational auditing, where the management might be carrying out some activity and they are updating to the right manager or to the right stakeholders about the performance of those operations. It could be project updates, it could be production data, it could be forecast, system related data. So these kind of operational reports. And other could be any other reports, for example, report on compliances and non-compliances internally prepared by the management, or even as an internal auditor, our internal audit quarterly update or monthly update to our senior management, or within the internal audit team, or quarterly update to the audit committee. These are also kind of a report. Sometimes it is not mandated how we prepare these reports and how we share these reports. In the same context, the management has to keep on doing. For example, the performance is always being evaluated on a regular basis in order to ensure that these operations are being performed in the right manner. And if in case there are bottlenecks, risks, so we can address on a timely basis. So the management, they have a lot of types of reports. Whenever we carry out audit engagement, we try to understand what are the key elements. We see if it is mandated by a law, regulation, or internal policies, or it is created by the management. And we also see the effectiveness of those reports. We verify the accuracy of those reports. We see the timing of the reports. We also try to review as an internal auditor, based on those reports, what instruction they receive from their line managers or the top management, and have they implemented those instructions or not. So management reports are one of the critical component of internal audit engagement that we have to take into consideration while performing the internal audit engagements. Another type of audit engagement that we carry out as an internal auditor, which is relatively still new in the domain of internal audit, because it's related to more soft aspect of the organization rather than very hard controls. It is known as organization cultural audit. It could be a separate audit where we just focus on the culture, or it could be an integrated audit, means that certain part of the cultural aspect we cover in each our audit engagement. For example, you are carrying out in finance audit. At the same time, you also assess what is the culture within the department, and is it aligned with the overall strategic objectives and the culture or the tone at the top of the organization. What is culture? Culture is basically a shared beliefs, values, and behavior. So basically what the majority of the people, they believe in it, and how that belief reflected in their behavior, that is a culture. Conduct is basically the implementation or the reflection of those beliefs in their actions. Similarly, there are certain risks associated with a bad culture. For example, if the culture is bad, people will be less conscious of the internal controls. They might create hurdles or problems, or they might be so careless enough by which we would not be able to achieve our organizational objectives. So a strong culture always enhance the control environment within the organization. Some of the key aspect of the strong culture is that the people working within the organization, they will have a high moral values. The retention of employees would be higher, so there will be less people who will be leaving the organization because they believe in the idea and the overall culture within the organization. The performance will be pretty enhanced within the organization because people are self-motivated or being motivated by looking at by the leaders, and the leaders are leading by examples. Contrary to that, weak culture will have weak controls, because there the people will be sometime what I have seen as an auditor, that people follow the letter of law but not the spirit of law. Means they just follow the instruction just for the purpose of following an instruction without actually getting the essence out of that instructions. So the controls will be weak, or people will try to find ways to override those controls. People will be posting bad about the companies, or they will be conducting wrongdoing, which eventually will lead to reputational risk to the company. Employees will be pretty disengaged, which means there will be high turnover of employees leaving the organization. Even those who are within the organization, they will badmouth about the organization. Some of the key role that internal audit has to carry out in such kind of audit engagements are: the auditor has to see whether it's, for example, in specific audit, specific department audit, their culture or overall within the organization, is it aligned with the strategy and the values of the organization. Cultural aspect can be audited as a standalone audit engagement, or could be integrated part of other engagements as well. I personally prefer to have an integrated element, because this way, if I'm doing 10 different, I'm covering in 1 year, for example, 10 different departments. So in each department, I see the local culture within the department and whether assess those cultural aspect to see whether it's in alignment with the strategic organizational culture and tone from the top. So this way, it is much more conclusive, because we go deep in each audit within the department, and similarly we can see the cultural aspect as well, rather than having a standalone cultural audit. Because even if you do a standalone cultural audit engagement, the ownership of the audit findings would be difficult to impose on the management, because the management would say this is what happens across the board. So who is responsible? All the departments. So it's a bit kind of more generic recommendation rather than being specific. So when you integrate the cultural aspect within each audit engagement, it is more enforceable within the department at a grassroots level, which eventually helps overall organization to enhance their culture. We also have to see the objectivity, confidentiality, and professional care. It is for internal auditor a must to have those ethical elements, but also in terms of operational management, that they should be ensure confidentiality, objectivity, and they should have the competence and professional care for what they are doing. So it is not only limited to internal audit, but it is also applied the same principle or ethical values for all the management within the organization. Lastly, we have to see what is the relationship of the culture with internal controls and strategic performance. If we found gaps, we have to identify those gaps. We have to recommend to the management to bridge those gaps. It might be interesting to know what are the key elements that contribute to a bad culture. For example, the top management put very unrealistic goals for the management, which eventually lead them to do some unethical behavior in order to save their jobs or to achieve such unrealistic goals. It could be because of rigid hierarchy, means there is no open communication, and you have to follow so much by the rule without going into understanding the spirit of the instructions. It could be due to poor communication from the top down and bottom up as well. Lack of accountability. So basically, if, for instance, there are 4 people working the same team, and there is 2 people who are very hardworking, or 3 people very hardworking, and one is mediocre or low performer, and he got promoted, while other people are not being rewarded well. So such kind of duality or lack of objectivity, or so sometime accountability as well, that you do not make this low performer accountable, may lead to increase the bad culture, the risk of a bad culture. Fear of reporting. There is always saying that if you want to assess a good culture, or to have a contrast between a good and bad culture within the organization, you have to see how fast the bad news reach to the top. If it takes way too long, or if it get interpreted and manipulated and put it forward as a positive news, then it means it's a bad culture. But if people doesn't fear to raise their voice and raise their rightful concerns and report to the management, if they are doing that, it means it's a good culture. The characteristics of the healthy culture is completely opposite of what is the characteristic of a bad culture. It is like the leaders lead by an example, ethical leadership. There is an open dialogue and align incentive with performance based. I have been in a board where there was tangible profit that the company could have made while twisting certain regulation, and the CEO has proposed that what if we can work around a regulation, we can have a massive profits. But the board member has completely declined the proposal, and they have said, no, we have to follow the spirit of the law, even if it comes at the expense of not making profits. So this is the tone. This one decision changed the whole dynamics within the organization, because the CEO knows that going forward, he doesn't have any room to play around with laws or regulations. So such kind of ethical behavior is required. And if it is there, eventually it leads to more resilient organization and good control environment. What are the tools that we can use in order to carry out such audit engagements in case if we have to? These are, for example, you will look for data. The data can be found through HR related data. For example, if there is a high turnover within the organization, could be a red flag for a bad culture. If too many people take sick leaves, and if there are too many complaints or grievances by the employees. And you can also assess through exit interviews forms and what were the reasons why these employees were leaving with the organization. The methods that you can use, that you can carry out interviews with different employees within the organization. You can have surveys conducted, anonymous surveys, because sometimes people are not comfortable raising their voice if it is a bad culture. So anonymity could lead to understanding of the culture. Observation, you yourself observe when you go and you see how people behave, act within the organization. Or you can have focus groups, means you bring together certain people and raise certain questions and see how these groups or what they say about those ethical dilemmas. So these are some of the methods which you can perform in such type of audit engagements. The documents that you can ask for is the key performance indicators, the performance appraisals, risk appetites. For example, what is the risk appetite that the organization board has approved, and are they monitoring those into different operational activities within the organization, and any risks that are beyond the appetite, are they reporting it or not? And if they are reporting, what are the actions or decisions are being made, and what are the actions that management is taking in order to mitigate those risks? So these you can see board minutes, committee minutes, even their management meetings. If you have access to those reports and performance reports, you can look into it. This also reflects some aspect of the culture. Also, messages from the leaderships. This also form the opinion about the culture. One of the most important elements within the cultural audit, that whenever you are forming those reports or carrying out those audit engagements, your report should have clear objectives, what you want to achieve from such audit engagement or audit activity, what is the scope of area, what are the aspects that you have covered and within the organization, what are your key findings, and what are your recommendations. So these are some of the key elements that you have to be mindful whenever you are carrying out a cultural audit engagement. Here we are at the end of this Unit 3 of CIA Part 1. Just to have a quick recap, in Unit 3 we have covered mainly 5 types of audit engagement. The first one was about operational audit engagement. What are the key elements that we needs to be mindful about? Second, we talk about compliance audit engagement. Third, then we talk about financial audit engagement and pretty much in detail. The fourth one was about management reporting, how we review such reports and what are the types of report, for example, financial, operational, or other reports. The fifth one, we talk about organizational cultural audit engagements. So these are the 5 types of audit engagement which we cover in Unit 3. Earlier in the previous Unit 2, we have covered 4 types of engagement. It was related to third party, quality, security, and privacy, and performance. So overall, we have covered a major chunk of audit assurance activities that we perform within the organization. And this gives you a very solid ground to understand that how you as an internal auditor carry out audit engagement in different types of areas within the organization, and what are the key elements and what are the key aspects of those areas that you have to be mindful as an internal auditor. With this, we will conclude this lecture, and hopefully we'll see you in the next video. Please do not hesitate to share these videos with anyone you believe that may benefit from. And secondly, I will be sharing the brief notes within the description of each unit, so that might help you to go through quickly as in a high level overview of each unit. And these brief notes, basically the main purpose is to keep it 2-3 pages, so you have a quick snapshot of what we have covered and what are the most important element within the units that you need to be mindful about. So with this, see you till next video, and please remember me in your prayers.